So, are you stuck in the classic dilemma of buying property versus just buying index funds? It's kind of the ultimate wealth-building showdown, and today, we're going to break the whole thing down using nothing but cold, hard math. Welcome to this explainer. Look, if you've ever felt that pressure to choose between becoming a landlord or just dumping your savings into the stock market, you're definitely not alone. It's literally the debate that takes over dinner parties and online forums. But here's the thing. Most people arguing about this, they're completely ignoring crucial pieces of the puzzle. They either forget to count the hours or they forget to count the zeros. So today we're putting both strategies head-to-head over a 20-year timeline. And honestly, the final numbers might actually make your stomach drop. Let's get into it.
Okay, let's dive into this. Meet Jake and Marcus. They're two identical investors, and to keep everything perfectly fair, they've got the exact same financial starting point. Jake has 50 grand in savings and makes a $55,000 salary. Marcus, exact same thing. 50 grand in the bank, $55K a year. They're the same age, live in the same city, and have the exact same amount of cash ready to deploy. The only difference here is the massive choice they're about to make with that 50 grand.
All right, let's look at Jake's play first. He takes his $50,000 and uses it as a 20% down payment on a modest 3-bedroom rental property priced at $250 grand. He locks in a 30-year mortgage at a 7% interest rate, which brings his monthly mortgage payment to roughly $1,330. But Jake, he does his homework. He finds a great tenant willing to pay $1,800 a month in rent. The math here seems incredibly straightforward, right? Rent comes in, mortgage goes out.
And that leaves Jake with this beautiful number, $470 in pure profit every single month before he spent a dime on anything else. Jake feels like an absolute genius. I mean, he's living the landlord dream. He's got a tangible asset he can actually drive past on his way to work. He's claiming mortgage interest deductions on his taxes, and he's got a really great story to tell his friends on the weekends. The social proof alone makes him feel like he is winning by a mile.
Now let's contrast Jake with Marcus. Marcus takes his $50K and just drops it straight into a total stock market index fund. He uses zero leverage, he has absolutely zero tenants, and there are exactly zero keys to hand over. He also sets up an automatic contribution of $300 a month and literally just forgets about it. Marcus's investment is invisible. It's boring. When friends ask him what he's investing in and he says index funds, nobody is impressed. He has a confirmation email, Jake has an actual house. So in terms of how it feels in year one, it's not even close. But as we know, feelings and math are two very different things.
Now, what's really interesting about this is how it completely shatters Jake's illusion of profit. Let's fast forward to year 3. Jake's gross cash flow, his rent minus his mortgage, looks fantastic at almost 17 grand. But then, reality hits hard. Property taxes drain $3,000 a year. Insurance is another $1,500. He already had to replace a water heater for $1,200 and fix a leaking roof for $2,800. Plus, he dealt with 1 month of vacancy costing him $1,800 in lost rent and another $600 just to clean and relist the place. And remember, Jake is managing this property himself to save a few bucks, which means he's frantically taking phone calls at 10 p.m. and coordinating repairs on his lunch breaks.
When you subtract all those real expenses from his gross income, Jake's actual net cash flow over 3 long years collapses to somewhere between just $2,000 and $4,000 total. Yeah, it is certainly not the massive profit margin he mapped out on a napkin on day one. And even more importantly, this tiny margin doesn't account for a single hour of the hundreds of hours he spent acting as a super stressed out part-time property manager. Meanwhile, let's check in on Marcus's portfolio at year 3. His initial 50 grand makes up the bulk of his wealth, but those quiet $300 monthly contributions have effortlessly added up to $10,800. And compounding is doing its magic. Roughly 10% average annual returns have added around $15,200 of pure wealth. So his portfolio is sitting comfortably around 76 grand. And what did Marcus actually do to earn this? He spent exactly 0 hours managing it. 0 phone calls, 0 plumbing emergencies. The compounding simply did the heavy lifting in the background.
But hey, we have to look at both sides impartially here. Jake isn't actually losing. And this brings us to the magic of leverage. By using the bank's money to control a $250,000 asset, Jake is building wealth in a way stocks just can't easily replicate. His $250,000 property has appreciated about 3 to 4% a year, so it's now worth around 280 grand. Because he controls the whole asset, his equity, which is just the difference between the home's value and what he owes the bank, has grown to between $55,000 and $65,000. That is real wealth, generated purely through the power of 5-to-1 leverage.
However, that gross rent check is really just a flashy headline. Let's drill down into the invisible costs, the money that just vanishes before the landlord keeps any of it. On average, you're going to face 1 month of vacancy per year. You absolutely must budget 1 to 2% of the property's value annually for maintenance. And then there are capital expenditures, or CapEx. Roofs and HVAC systems die, and when they do, they demand 5 to 15 grand in a single chunk. Boom, gone. If you hire a property manager to save your sanity, well, kiss 8 to 10% of your gross rent goodbye immediately. And the absolute worst case scenario, evictions. Those can cost you 3 to 6 months of rent plus legal fees. Because of these brutal realities, by year 5, Jake's actual cash-on-cash return is hovering at a super meager 3 to 5%.
Let's move to the wealth curve and see how this actually builds. As we step through year 1, year 3, and year 5, Jake's wealth grows, sure, but it grows slowly after his massive expenses, and it requires constant, active attention. Marcus's wealth, on the other hand, is going on a curve. It's incredibly boring for the first 5 years, but as we start looking toward year 10 and year 20, the magic of compounding really takes over. The gains on Marcus's gains start generating more wealth each year than his original contributions. The next 15 years for Marcus are going to be mathematically astonishing.
At the 10-year mark, we hit this really fascinating tiebreaker. Jake's property has appreciated, and his mortgage balance has dropped, leaving him with an impressive $170,000 to $184,000 in equity. Marcus's totally hands-off portfolio has grown to an almost identical $165,000 to $180,000 grand. Their wealth is surprisingly close. But here is the massive differentiator. Over that decade, Jake has spent $20,000 to $35,000 out of pocket on repairs and maintenance, right alongside hundreds of hours of intense stress. Marcus? He spent precisely 0 weekends fixing anything and never lost a single night of sleep.
And that brings us to the climax of this explainer. 20 years later, the results are staggering. Jake's mortgage is nearly paid off. His property value has climbed, and he's collected 2 straight decades of rent. His total net worth tied to this property sits right between $400,000 and $500,000. Now, Marcus's stock portfolio, fueled by 2 decades of uninterrupted compound growth, sits in the exact same ballpark, between $420,000 and $460,000. After 20 long years, they are effectively tied. But this brilliantly illustrates a vital difference in lifestyle. Jake actively worked for his wealth for 20 years, managing tenants and fixing broken pipes. Marcus? He simply waited for his.
But there is a mathematical twist here that heavily favors the stock market, the compound multiplier. If Marcus increased his monthly contribution by just $200, literally the cost of a couple of dinners out, his 20-year portfolio jumps dramatically to nearly $600,000. Adding just a little more cash to stocks creates this exponential, effortless compounding effect. If Jake wants to significantly increase his real estate returns, he can't just toss an extra $200 at his house. No way. He has to save up another massive down payment, take out a second mortgage, buy a second property, and completely double his workload and liability.
Now, if I only showed you the downsides of real estate, I'd be as bad as a biased finance influencer. We absolutely have to impartially outline the brutal reality of stocks. The volatility is visceral, and frankly, it's terrifying. I mean, the market dropped 37% in 2008, and it plunged 34% in just 1 month in 2020. Watching your life savings plummet by tens of thousands of dollars in a single week induces a unique kind of panic, and the data shows most retail investors sell at the exact wrong time. Plus, stocks offer almost no usable cash flow to live on today. You don't have access to leverage, you only control the exact amount of money you put in. And you get absolutely none of the magical tax shelters, like depreciation, that the government just hands out to real estate investors.
So, to balance the argument completely, we really must acknowledge exactly when real estate truly dominates and creates millionaires. Because real estate does win in highly specific, identifiable situations. It wins when you find a market with a strong rent-to-price ratio, hitting that 0.8 to 1% rule on day one. It wins when you treat it strictly as a business with actual systems, not just as a messy side hustle. It becomes incredibly powerful if you use house hacking to live in one unit and rent the others out, reducing your own living costs to basically zero. And it wins massively if you utilize 1031 exchanges, which allow you to roll profits into new properties entirely tax-free, growing your portfolio at light speed. So the crucial point is this: the real trap isn't choosing real estate, and it isn't choosing index funds either. The real trap is picking either path based on a sensational YouTube headline, a 30-second podcast clip, or random advice from your uncle at Thanksgiving. Neither asset class is inherently a bad choice, but choosing one without ever running the full mathematical simulation for your own specific lifestyle, your risk tolerance, and your goals, well, that is financially dangerous. Which brings us to the end of our explainer today, and I want to leave you with this final, provocative thought. The next time someone at a barbecue or online confidently claims that real estate always wins or that the stock market always wins, I want you to ask them this one simple question. Did you include everything? Because the only answer that actually matters for your wealth is the one that includes every single dollar and every single hour. Thank you so much for learning with me today, and keep asking the hard questions.